Well, hello everyone. In this recording, we're going to take a look at some of the homework problems in Chapter 21. All right, as a review, real quickly, Chapter 21 was about capital budgeting decisions. And basically what this means is the company is about to embark on a large, buying a large fixed asset, a machine, a building, piece of equipment that is going to add to cash flows in the future. And so the question is it worth buying the machine now to generate future cash flows? And the issue here in this chapter is that a lot of the cash flows that we're talking about occur right now, and some of the cash inflows and outflows occur in the future. Well, because of this concept called the time value of money, or inflation, as an example, is a good issue dealing with the time value of money. A dollar today is worth more, or it has more purchasing power than a dollar tomorrow. You've all heard the stories about how a dollar was worth a whole lot more long ago, and it's going to continue. A dollar is going to continue to have less and less worth in the future. And so what we do in this chapter when we do these analyses is a lot of times what we do is we convert all of the cash flows in the future to present value. And so that's a lot of what we're going to learn about in this chapter. So let's take a look at the first, with that little introduction, let's take a look at this first situation here. We have a company, they're a candy company. They are considering purchasing a second chocolate dipping machine to expand their business. If they do so, I'm over here in the data table. You can see me circling it with my cursor. If they do so, the cost of the machine is going to be $90,000 that they will be able to, they will have to spend that today. That is a cash outflow right now. If they do that, the machine will have an 8-year life, and each year it is our estimation that it's going to contribute an increase to the contribution margin of $18,000 a year. The required rate of return, effectively that's the going interest rate, the prevailing market rate at this point in time, 6%. There are many names for this. Cost of capital is another name for it, 6%. All right, so the company estimates they'll be able to produce more candy using the second machine and thus increase their annual contribution margin. They also estimate there will be a small disposal value of the machine, but the cost of removal will offset that value. So basically what they're saying is at the end of 8 years, this machine that we're buying for $90,000 today, it'll have a small value at the end of 8 years, but we have to remove it, and the removal cost will kind of wash out with what minimal amount we can get in disposal for it. So we're not going to even consider that potential cash flow at the end of year 8. We're going to ignore income tax for this particular situation, and we need to assume all cash flows occur at the end of each year. So the first requirement here in this homework problem is to calculate the net present value. And the net present value of this particular purchase, if we do so, we're going to make an initial investment today of $90,000. You can see it's in brackets. That means it's a cash outflow. Right? Accountants always put brackets in numbers in brackets if they're talking about outflows or negatives. So that's already, since that $90,000 needs to be spent today, it is already in present value term. So negative 90. And what we're going to do is we're going to receive an additional $18,000 a year at the end of every year for 8 years. And so to convert the $18,000 a year for every year for 8 years, you're not simply going to take 18,000 times 8. All right, that's not doing any conversion. What we need to do is we need to convert it to present value. And so since this is the same amount, 18,000 every year for 8 years, that is called an annuity. So for those of you that have a textbook, you will see in the appendix to the textbook, there is a table. It's table number 4. It is called the present value of an annuity table. And the way these tables work you are going to take a look at the columns at the top. Those are the percentage rates. And in this case, it is a 6% required rate of return. So I'm going to go to the column that says 6%, and I'm going to work down to, along the rows, we have the number of periods. So I'm going to go to row where it says period 8, and I'm going to go to the 6% column. And the factor that I find is this right here, 6.21. So if I take the 6.21, multiply it by $18,000 a year, I get $111,780. That is basically the same. So if I got $18,000 a year, $18,000 every year for 8 years, I will receive over the 8 years a total of $144,000. But that would be the same as receiving $111,780 today. What we've done is we've converted the future cash flows of $144,000 into the present value, which is $111,780 minus the net initial investment. You can see the net present value of this particular investment is positive. As long as the net present value is 0 or positive, 0 or more, financially speaking, it can be accepted. Okay, part B. The author is asking us to calculate the payback period. There is a formula for the payback period. When we have the same cash flows every year, we're simply going to take the net initial investment divided by the increase in cash flows. That works out to 5 years. Now, if the annual cash flows are different every year, we'd have to do some sort of table to start with the 90,000 and then keep subtracting the amount of the cash flows until we get to the point where we have the payback period. But in this case, it's very straightforward. With annual cash flows that are the same, here is your formula to figure out the payback period. Net investment divided by the increase in cash flows. Part C, the author is asking for the discounted payback period. So what we are doing here with the discount payback period, we're going to start with year 0 on this table at $90,000, and we're going to work through our $18,000 net cash inflow every year, but we're going to discount it back to present value. So once again, if you have the tables in your appendix to your textbook, you will go to table number 2, which is present value of $1. And once again, we're going to be in the 6% column. And under period 1, you can see the factor is 0.943. So if we take the 18,000 and multiply it by 0.943, you get 16,974. And that will be the cumulative amount since it's period 1. Subtract that from the 90,000, you'll get 73,026. In year 2, same 18,000, but if I look at the factor under the 6% column, period 2, I get 0.89. If you multiply 18,000 times 0.89, you'll get 16,020. Add that to the 16,974. Here's the cumulative discounted cash savings, 32,994. Subtract that from the 90,000, you will get your 57,006. Well, anyway, you keep walking through, and you can see the payback period. We have to work all the way through year 6, and sometime in the middle of year 7, we have made it up. All right, at year 6, we still have a little bit of the investment to make up, and so there's a little calculation here. We're going to take 6 years, 6 full years, plus, and we do a little calculation. In the last year, we have the final balance of $1,494 divided by the next year's savings, which is year 7, of $11,970. That gives us kind of a percentage of a year that we work into year 7. So 6 plus the percentage of year 7 that we work through. So we get 6.12 years. So the payback period without discounting, if you recall, was 5 years. But when we do discount to present value, you could see it's 6.12 years. Letter D, the internal rate of return. The internal rate of return is when the net present value is 0. That's what that means. The internal rate of return is when net present value is 0. And so in order to calculate the internal rate of return, we are first going to take the initial investment divided by the annual cash inflow. So in this case, $90,000 divided by 18,000, that gives us 5. That is the present value factor. And so if we go to our present value of an annuity table, once again, table number 4 in your appendix to your textbook, what we're going to do is we are going to go to period 8. Remember, this is an 8-year life. So if I go to period 8, I'm going to work my way across until I find 5.0. Well, I don't find 5.0 perfectly, but I see in the 10% column, the rate is 5.335. And I see in the 12% column, the factor is 4.968. So the internal rate of return is going to be somewhere in between 10% and 12%. Okay, so what we are going to do is this. In order to figure out exactly where in between 10% and 12% the internal rate is going to be, what we will do is you will subtract the 10% factor, which according to the table is 5.335 for 8 periods, and the 12% factor is 4.968. The difference is 0.367. And the internal rate of return, like we said, is somewhere in between the 10 and the 12. It's probably in the 11% range. And so if we take the 10% factor minus the internal rate of return factor of 5, the difference is 0.335. So the internal rate of return is going to be 10% plus a fraction. And the fraction is going to be this 0.335 divided by the 0.337 times 2%. The reason it's 2% is because it's the difference between the 10 and the 12. So when you do the math, the internal rate of return is 11.83%. You could see we knew that the internal rate of return was somewhere in between 10 and 12%. Specifically 11.83% if we wanted to do an exact science. Okay, letter E, the author is asking us for the accrual accounting rate of return. And so with the accrual accounting rate of return, we are simply going to figure out first our annual depreciation. So if the investment is $90,000 and we said disposal value or residual value at the end is pretty negligent, pretty much 0. So if we take $90,000 divided by its useful life of 8 years, that works out to annual depreciation of $11,250. So if our cash savings, as we said earlier, was $18,000, all right, and we know the new depreciation for buying the new machine is $11,250, our accounting income, remember, the $18,000 is cash, extra cash inflow. But when you bring in this concept of depreciation, right, we're talking about accrual accounting here. So with accrual accounting, you know that $11,250, even though it's not a cash outflow, it's going to be subtracted from the $18,000 to get you to accrual accounting income, which is $6,750. And we will divide that by the investment of $90,000. So the accrual accounting rate of return is 7.5%. As you can see here, there are various ways to analyze this. In my opinion, the best way, of course, is the net present value method, because you're bringing everything down to the same playing field, as I like to say, which is the dollars and today's value. But certainly there are various ways to analyze this. Okay, in this next example, we have a company. They are a rapidly growing biotech company. Their required rate of return, or their cost of capital, is 8%. They're planning on building a new facility in Santa Clara County. The building will take 2 years to complete. The building contractor offered the company a choice of 3 payment plans. And so the author is asking them Let me see. What are the payment plans? Okay, here they are. Okay, so I'm over here. Plan number 1. They can choose, the company can make a payment today of $125,000 at the time of signing the contract, so that's today's dollars, and they can wait and pay the rest, $4,575,000 upon completion of the building. Remember, it is our estimate that the building is going to take 2 years to complete. Or we can choose Plan 2. We can pay $1.8 million today and pay $1.8 million at the end of each of the next 2 years. So at the end of year 1, $1.8 million, the end of year 2, $1.8 million. Or Plan 3, we can make a down payment today of $300,000 and we will pay $1.575 at the end of each of the next 3 years. So Plan 3 is actually stringing it out for 3 years. So how do we choose? These numbers are completely different. And so what we want to do is we want to bring everything down because we are dealing with future cash outflows. We want to bring everything back to present value. That would be the best way to analyze this situation. So Plan 1, we can see Plan number 1, we can make an initial payment of $125,000. That number is already at present value because that amount is paid today. And we would be able to pay $4,575,000 at the end of year 2. So to convert this future cash outflow to present value, we would look at Table 2 in the appendix, which is present value of $1. And if I go to the what percentage rate? 8%. So if I go to the 8% column and go to period 2, the factor I see is 857. Multiply that by the dollar amount that we would need to pay, and that equals the present value of the 4.575. And so the net present value, $4,045,775. Plan 2, we'd make an initial payment of $1.8 million. At the end of year 1, we'd make another $1.8 million payment. So using the same table, 8% column, period 1, we see the factor is 0.926. And year 2, as we said earlier, the factor is 0.857. Multiply each of them by 1.8 million. So the present value of Plan 2 is $5,009,400. And Plan 3, we can make an initial payment of $300,000, or we can string it out for 3 years. $1,575,000 payments at the end of each year for the next 3 years. We saw the factor for period 1 is 0.926. For period 2, the factor is 0.857. And lastly, for period 3, which we're seeing for the first time, 8%, period 3 is 0.794. So bringing everything down to the same playing field, $4,358,775. Out of the 3, the lowest net present value is $4,045,000. So Plan 1 would probably be the best, financially speaking, the best plan to choose. It's the lowest net present value. And when we're dealing with cash outflows, you want to select the lowest net present value. Obviously, if this was reversed, we were getting cash inflows from a project, we would choose Plan 2, but that's not what we're doing here. We're dealing with cash outflow, so we want to choose the lowest net present value of the dollars. Okay, in this next problem, we have a bakery, and the bakery wants to buy a new oven for the store. If they buy this new oven, the new oven's going to have an estimated useful life of 4 years, and the estimated pre-tax cash flows for the oven are as follows. So you can see the table. If we buy the oven, we're going to buy it right now in period 0, negative $70,000, cash outflow of $70,000 today. And if this oven is put into place based on our estimates, the annual cash flows from operations, excluding depreciation, excluding taxes, $24,000 a year for 4 years. And at the end of 4 years, the oven will still have some value, and we'll be able to dispose of the oven at the end for $7,000. And so what we need to do here is we need to calculate net present value of this project, the payback period, and the internal rate of return. So first, the net present value. Once again, this is just converting all dollars, all future cash inflows and outflows to the current present value. We will do so by using the present value tables that you see in your appendix to your textbook. In addition, the present value tables are up here in links to your homework. So, first, the annual cash inflow, as we said, was $24,000 a year for 4 years. So $24,000, but that is pre-tax. And so I need to go on and read to you, the bakery has an 8% required rate of return and a 34% income tax rate. So if I take $24,000 and subtract out the income tax expense, which is $24,000 times 34%, after tax cash flows, so this is true cash flow after taxes are paid, $15,840. More on that in a minute. Additionally, I want to figure out what are the cash savings. Remember that we didn't even consider depreciation here. So if we do our straight line depreciation, as you learned in prior accounting classes, the cost of the asset was $70,000. Subtract out the disposal value of 7. This is the depreciable basis divided by the estimated useful life in years divided by 4. All right, so that would be the depreciation, whatever this amount would be, the $63,000 divided by 4. So if that is the additional depreciation expense, if our tax rate is 34%, I would actually save, this would be cash savings, by implementing and depreciating the new piece of machinery. So that's important as well, the $5,355. So in order to do the net present value, we have our negative $70,000 cash outflow today. And for 4 years, remember we said the after-tax cash flows, $15,840. Multiply it by the factors. Once again, if you go to the present value of an annuity, present value of a dollar table, 8% column, period 1, the factor is 0.926, period 2, 0.857, period 3, 0.794, and period 4, 0.735. All right, and you multiply them by the net cash inflow after taxes. Here are the present values for all that. In addition to the additional cash flows after tax, we have the savings on our taxes from this additional depreciation expense. The same factors for the 4 years, and we said earlier the tax savings from depreciation, $5,355. So here are our 4 amounts, and then of course at the end of 4 years we'll be able to get a $7,000 cash inflow from disposing of the equipment. And if I go to my present value of a dollar table, I go to the 8% column. At the end of year 4, it's 0.735. So if we do the math in this last column, the net present value of the project is positive $5,343. I know I keep mentioning going to the appendix of your textbook, but as I said, you can also come here. They are links. So as an example, let me just click on the present value of a dollar table. Here are the columns up top, percentages, and the rows are the periods. So we were in this 8% column, and you can see here are the factors, 0.926, 0.857, 0.794, and 0.735 for the 4 periods in question, which are here. Okay. All right, part B, the payback period. And as we said, the increase in the after-tax annual cash flows are not only the $15,840, but also the $5,355. So the increase in the after-tax cash flows, or the sum of the two, or $21,195. If we take our initial investment of $70,000 divided by the $21,195, it's going to take 3.3 years to get that money back. And part C is the internal rate of return. So let's take a look at the internal rate of return. Once again, the internal rate of return is when the net present value is 0. So just using a little bit of trial and error, if we take a look at our present value tables, once again, you'll click on here to get your factors. But in the 10% column, if our initial investment is negative $70,000, and we said here are our cash flows, after-tax cash flows discounted for the 10% column. So if we take the 10% factors and multiply it by the after-tax annual cash inflows, we are going to get these numbers. So let me show you real quickly the present value table. If we take the 10% column, 0.909 is the factor for period 1. So the what was the you remember the the cash inflow was $15,840. If you multiply it 0.909, you're going to get the $14,399. And then the next column, 15,840, and we will multiply it by 0.826. You will get the 13,084, etc., etc. So once again, just taking the 15,840 and converting it to present value under the 10% assumption, and the 5,355 were the annual depreciation savings on the taxes, converted to present value using the factors in the 10% column. So with 10%, the present value is positive 1,945. 12% column, we saw the net present value is negative 1158. This tells me that somewhere between 10 and 12% is when the net present value is 0. Somewhere between the two, somewhere between 10 and 12%. We went from positive net present value to negative net present value. And so what we're going to do is we're going to see the spread between the two, the positive 1949 and the negative 1158. The spread between the two is $3,107. And so to calculate the exact amount between 10 and 12%, where the net present value is 0, also known as the internal rate of return, it will be 10% plus, like I said, the spread between 10 and 12 is 2%. 2% times, at the 10% level is your numerator, your denominator is the spread. That gives you a fraction. So 2% times the fraction plus 10%, 11.25% is the internal rate of return. This is the exact amount where the net present value is 0. And last but not least, the accrual accounting rate of return. Once again, you know with accrual accounting, we need to deduct the depreciation expense from the annual cash inflow. Earlier we said many times the annual cash inflow was $21,195. We saw that here. It's the after-tax cash inflow from the increase to the margins plus the tax savings, $21,195 minus the annual depreciation, which is calculated up here, cost minus salvage value divided by the useful life. So if we take our annual cash inflow minus the annual depreciation, that gives us accrual accounting operating income, which we will divide by the investment. That gives us 7.78%. That is known as the accrual accounting rate of return. In this next problem, we have a company. They need to overhaul its auto lift system or purchase a new one. Here are the facts. So you can see the data table giving us the facts. If we stay with the current machine, the original purchase price a long time ago was $125,750. The current book value, all right, so if I sold it today, I would be able to sell it for $49,000. That's the salvage value. If I sold it today, the book value is $34,850. But if I stayed with the current machine, I would still need to pay $28,250 to overhaul it. If I do so, my cash operating costs are $69,000 a year. If I flat out bought a new machine today, instead of paying $28,250 today, I'd have to pay $160,800. But if I did that, my annual cash operating costs go down. Instead of $69,000 a year, it's $56,800. And the salvage value after 6 years is a lot higher than the current machine of $8,000. It's $30,500. So the fact of the matter is we need to figure out what we want to do. So first thing we're going to do is figure out what is the present value of the operating costs. So the current machine is $69,000 a year. And because it's $69,000 exactly every year for the next 6 years, the current rate of return, required rate of return, is 6%. So what we're going to do is we're going to use our present value of an annuity table. That would be here, the present value of an annuity table. So if we go to the 6% column, you should see it here, the 6% column, and it's for 6 periods, what do you get? 4.917. That's the factor, 4.917. So we will multiply the cash operating costs for the new machine. It was $56,800. The old machine, it was $69,000. You can see the present value of the cash outflows are a lot lower if we bought the new machine than the current machine. Next, we have to consider the salvage value at the end of 6 years, excuse me. Current machine, it was $8,000. And the new machine, if we went that route, it would be $30,500. But those are what it's worth 6 years from now. So present value of a dollar table, let's pull it up. Once again, we are in the 6% column. And at the end of year 6, what is the factor? 0.705. So that is the factor we're going to use when we calculate the actual present value of the salvage values. You can see the new machine, the present value is a lot greater than the current machine. And the operating costs are a lot lower than the current machine. So far, it's looking very good for buying a new machine. Okay, so here is the overall net present value. If we overhaul the existing system, we'd have to spend $28,250 right now. There's no conversion we need to do to present value because it's already there. Plus, we would have $339,273 in present value operating costs, and we'd get $5,640 at the end. So the overall net present value is negative $361,883. But if we invest in the new system, we'd have to spend a whole lot more today, $160,800. If we do so, we'd be able to get $49,000 salvage value for the old machine today. Once again, if we bought the new machine, we can sell the old machine today. And we said earlier the operating costs, present value for the new machine, negative $279,286. And the present value of the salvage at the end of 6 years is $21,503 positive. So the present value is negative $369. It's a lot closer than you would think, right? It's fairly close. It's still, the argument financially is still to overhaul the existing system. It's a little bit cheaper over 6 years. It's about $8,000 cheaper. All right. But if we didn't go through this exercise, we would be comparing the $28,000 with the $160,000. And that would have been wrong. We have to consider everything that's going to go on over the life of the project. That's what this whole chapter is about. Really understanding the future cash inflows and outflows and converting them back to present value. This next homework problem deals with relevant costs, like what is relevant for the decision. All right. And what we have here is we have a company, they are replacing a print machine. So the data given to us in the data table, you can see that the net book value of the old machine, if we sold it today, the net book value is $13,000. If we bought the new machine today, we'd have to spend $190,000. The down payment on the new machine, that would be cash outflow right now, $38,000. The sales price of the old machine is $35,000, and our tax rate is 32%. So what is relevant for the decision? Okay, so first what we're going to do is we need to figure out, okay, the cost of the new machine, even though it's not all spent right now, today, all of it is relevant. So $190,000 is certainly part of the answer, but that's not the full answer. How about selling the old machine of $35,000? Is that relevant? Of course it is. That is cash inflow we're going to receive. So $190,000 is a cash outflow. $35,000 is going to be a cash inflow. And in addition, remember, we need to pay taxes on our accrual accounting income. So if we sell the old machine today for $35,000, it's got a book value of $13,000. That means, accounting-wise, the gain on the sale of the equipment is $22,000. If our tax rate is 32%, $22,000 times 32%, we need to pay additional taxes of $7,040. So spending $190,000 on the new machine, spending $7,040 on the new tax bill, but saving $35,000 on selling the old machine, the relevant cost for the decision is $162,040. In this last homework problem, we have a company, Larry's Enterprises. They purchase a new machine tool which will allow the company to improve efficiency of its operations. On an annual basis, the new machine will produce 15,000 units with an expected selling price of $23, prime cost of $7 per unit, and fixed cost allocation of $3 per unit. Annual depreciation on the machine is $11,000, and the tax rate for the company is 38%. So the question is, what is the annual cash flow generated from the new machine? Well, the sales, additional sales, $23 per unit times 15,000 units, additional sales of $345,000, additional cost of $7 per unit times 15,000 units, additional cost of $105,000, so additional cash flow of $240,000, but we have to pay taxes. Tax rate is 38%. 38% of the $240,000 is negative $91,200. That's not all though. We also have to worry about depreciation. So the depreciation is, let me see, $11,000. We said the annual depreciation is $11,000 and the tax rate is 38%. If you take 11,000 times 38, that's 4,180. All right. This tax was actually decreased because of the depreciation. So what we're going to do in order to calculate cash flow, that tax decrease, we're actually going to add it back when we're trying to figure out the cash flow generated from the project. $152,980 is your answer.